Tamid. So Tamid is a non-profit organization that develops professional skills for undergraduate students through interaction with Israeli economies.
Beyond Meat. They produce burgers that look, cook, and taste just like meat. But they're not what we think of as meat. They're made entirely.
So Bharti Airtel Limited, formerly known as Airtel, is a leading global telecommunication company with operations in over 18 countries across Asia and Africa. Airtel has grown well beyond its Indian roots.
And again, thank you mentors for being here. Thank you judges for being here, and most of all the members who have put in, I can't imagine how many hours. Like the exams are next week, and these guys have spent like countless hours making these slides. So I'm very delighted and very proud of each one of you. We can start with team one if someone wants to share.
Good evening, ladies and gentlemen. This is Aditya, and my team Arun Manji and Sakshi Ramchandrani are going to pitch you about Beyond Meat. Next slide. And we'll be covering all these topics, and I'll be talking about company overview. Beyond Meat is a Los Angeles-based plant-based meat substitute, which is founded in 2009. The company has products designed for emulated beef, meatballs, ground meat, and pork sausages, and patties as well. Their main mission is to eliminate carbon dioxide and animal brutality as well. So this is the main overview of the company. Here is the market cap of 8.21 billion. Previous slide, Aaron. The market cap is 8.21 billion. The stock price is 130.37 currently. And their main sources of income is from retail and restaurants. And the main ingredient in their product is pea protein. And they're available in two types of products, basically. One is in ready to cook products, and one is ready to heat products. Next. These are the annual revenues of Beyond Meat. They have been gradually increasing since they started. And this is the team of Beyond Meat. Next slide, Aaron. Ethan Brown, the founder and president of Beyond Meat. Mark G. Nelson, chief financial officer. Beth Moskowitz, chief creative officer. Sanjay C. Shah, chief operating officer. Here's the timeline of Beyond Meat. They founded in 2009. They launched their products in 2012. And Beyond Meat went public in 2019. And over to Sakshi.
Thank you, Aditya. Now, coming to the industry insights of plant-based meat, a mind-boggling fact is that this industry stood at $4.7 billion market valuation in the year 2020. It is further projected to reach $8.3 billion by 2025, and the reasons for its incremental growth is backed by strong demand shifts, population switching to healthier lifestyles, the new food trend of veganism, and the flexitarian population that consumes both vegetarian and non-vegetarian meals have also displayed a high interest for this plant-based meat. Further, these demands have been supported by various government initiatives and global investments and has provided a strong financial backing to this industry. The Northern Europe and US are predicted to dominate this industry due to innovative product developments in the regions, supported by research and development facilities as well. While many challenges exist for this industry, futuristic opportunities lie for these markets when favorable marketing and correct positioning of plant-based meat is done in accordance to the leading industry trends. Next slide, please. I'm beginning with the first trend, that is the regenerative agriculture has become the new gold standard. What I mean by this is that products are not expected to just have some sort of environmental impact in today's world. They are expected to have a positive environmental impact. As a result of which, these regenerative agriculture techniques focus on enriching soil rather than depleting it. Along with this, carbon labeling has also become highly trending, where consumers want to know about the contents of their food and the environmental impact rather than just calorie and other product details. Along with this, an interesting insight is also that eating in and out at the same time have become trending. The COVID-19 pandemic has enabled a lot of people to start cooking at home, experimenting with various food recipes, and at the same time have what on their focus in the new ingredients introduced in the market in terms of cooking oils, where coconut oil, that is a plant-based oil, has become the hot product. And along with that, they have also become tired of just living and eating from home. So there's a surge in online food and beverage sales as well. And with the obviously popular plant-based meat, other alternatives such as egg alternatives and alternatives to the vegan the fish products have become highly trending as well. And while we notice that there's a high population that still depends on meat consumption, at the same time, the type of the meat preferred is also changing slowly from just beef and chicken to the poultry meat. So these are the trends that highlight the industry. Now, moving on to the next slide, we see the environmental impacts that these lab-grown meats have in terms of reducing carbon emissions, and at the same time, we see the US plant-based meat market evaluation by the different sectors of burgers and sausages leading the industry, and at the same time, we see the end users divided specifically between the HoReCa segment, that is hotels, restaurants, cafes, and retail segment. Next slide. Now, Google Trends is an interesting way to analyze what the consumers are interested in. So we notice a high demand for a high search about plant-based meat, specifically from beginning from 2020, and with its various fluctuations up till the current period. And when we evaluated, next slide, when we evaluated the industry players, we saw Beyond Meat is the most known company in terms of the plant-based industry. And next slide. It is further predicted to have a market valuation of 29% by the year 2030. Next slide. And we see the returns. In terms of the stock market returns, Beyond Meat still stands way behind as compared to the leading companies of Tyson Foods and Ingredion. Now moving on to Alan, who will further discuss the financials briefly.
Thank you, Sakshi. I'll be talking about the financials and valuations. Moving forward to the discounted cash flows, Beyond Meat revenues is expected to grow throughout the fiscal years, accompanied with an increase in EBITDA. Furthermore, the growing positive net working capital entails the company can cover its current obligations. The company doesn't pay dividends, as seen with the payout ratio. The company essential ratios are poor, as Beyond is fairly in a new market while in a pandemic, but we expect these ratios to improve as the industry trends adjust to the plant-based meat idea. The projected unlevered cash flows shows by 2027 and onwards, Beyond Meat will realize positive free cash flows accompanied with a growing net operating profit after tax. However, the weighted average cost of 6.7, which entails a risky investment that might be due to high costs associated with the farm's operations, we believe the risk will scale down as the economies recover from the pandemic and as the plant-based meat community expands. Moving on to the stock price analysis, Beyond Meat went public in 2019, initially valued at $25 per share, which soared to 163% on its first day trading alone. The current price is $130 with the company's total value being $8 billion and $8.2 billion market cap. However, these earnings have been poor and underperforming, but we are confident the numbers will pick up in the near term or future. Moving on to the comparable companies analysis, Beyond Meat is the leading company in the plant-based meat industry among other competitors, whether public or private, using the EV, EBITDA, and the EV revenue. Moving on forward, Sakshi will now talk about the investment thesis and risks.
Right. So after looking at these negative figures and noticing that Beyond Meat hasn't really earned a profit in the last 4 years, the million-dollar question comes in: why should you really invest in it despite all the frightening numbers? So firstly, we see that it has expansion strategies into the HoReCa segments. As we mentioned before, that the past and the current focus of Beyond Meat has been on B2B consumers, but now it will further move on to reach the direct end consumers through expanding its operations and partnerships with popular retail chains like PepsiCo, McDonald's, and Taco Bell, which also led to a surge in the stock market by 42% in the recent January 2021. And it also intends to launch a new e-commerce platform that enables direct access to the end consumers. Further, we also see positive changes in investor environment, that is more government support policies, and as I mentioned, US and Northern Europe being more favorable of these industries. And at the same time, we also noticed that Beyond Meat intends to extend its operations in Asia, which is marked with the highest populations, and specifically in China, wherein it will first set up its production plant as the first vegan meat company in China, which will again bring in favorable opportunities and by access to more distribution channels and consumer segments. Further, it also has a future growth potential. That is, despite not being able to earn a profit in the last 4 years, it has a positive growth market valuation in terms of revenues. That is, it is expected to reach up to 29% by 2030. And obviously, it is known for its good environmental impact. And based on the technology it introduced, it has a long-standing reputation and goodwill in the market, which again proves a favorable opportunity to both investors and the company. Now, moving on to the numbers side. No, previous slide, please. Yeah. So Beyond Meat stock has plunged more than 8% after the earnings announcement in the past few months, but expectations are set on the future growth by fueling partnerships with the retail chain just mentioned. And recently, they have also added various convenience stores and partnerships with Alibaba's grocery stores. Now, financial metrics are only a part of the equation when deciding to invest in a visionary but loss-making stock. Management's ability to articulate its vision and successfully manage its supply chain also contribute heavily to the investment. As a result of which, we would suggest now to observe the operations of Beyond Meat until the quarter 2 and quarter 3 of 2021, and until then hold their stocks and further buy them in the upcoming future months. Moving on to the risks, the main risks that are held for this company is reliance on one co-manufacturer that was revealed by the annual reports of 2019, which further possesses a risk that if this manufacturer decides to terminate the contract with Beyond Meat will be left with nothing. And the other risk is obviously of Beyond Burger being the most famous product. But again, Beyond Meat is coping with this risk by introducing more sausages, meatballs, and other products which are in demand as compared to its competitors, which also helps them deal with the competition. And it was also noticed that Beyond Meat's leading competitor, Impossible Burger, was not able to maintain its supply chain when it introduced its partnership with Burger King. So that gives Beyond Meat an advantage by a positive supply chain management and other positive future expansion plans. That'll be the end of this presentation. Thank you a lot for listening to us.
Oh, wonderful. It was just about in time. So thank you, Team 2, for the solid presentation. I feel like I need to get a Beyond Meat joint in India as soon as I can. But having said that, the floor is open for the panelists.
Presenting the company analysis on Airtel. My group includes Aryan, Wazifa, Mera, and Animish. Please go to the next slide. So this is the agenda. You can have a brief look over it, but I'll skip through over it. Next slide. Okay, so Bharti Airtel Limited, commonly known as Airtel, is a leading global telecommunication company with operations in over 18 countries across Asia and Africa. Airtel has grown well beyond its Indian roots to be recognized as a highly acclaimed global brand. Demonstrating its ability to adapt to the changing industry dynamics, Airtel is one of the largest global consumer brands to have emerged out of the country. Headquartered in New Delhi, the company ranks amongst the top 3 mobile service providers globally in terms of subscribers, with almost 457 million subscribers globally. In India, the company's product offerings include 2G, 3G, and 4G wireless services, mobile commerce, fixed line services, high-speed home broadband, as India's largest private home broadband player with over 2.4 million customers, DTH and international long-distance service to carriers. In the rest of the geographies, it offers 2G, 3G, 4G, wireless services, and mobile commerce. Airtel has over 403 million customers across its operation at the end of March 2019. The key, previous slide, please. The key metrics are mentioned here. And next slide. Now I'll be talking about some of the milestones that Airtel has achieved over the years. So the first is in 1995, they launched their cellular service in New Delhi. In 1998, They were the first private sector company in India to introduce fixed line services in Indore. 2002, they closed their first IPO. 2011, their first 3G services were launched in India. 2012, they launched their 4G, and in 2020, they became the first operator to launch 4G in 26 villages in India. Now, Wazifa will take it on further for the business model.
So the key areas of business for Airtel are mobile services, which domestically and internationally includes 2G, 3G, and 4G, and Airtel Business, which includes voice, data, video, network integration, data centers, managed services, and enterprise mobility applications. The company makes revenue from various sources. As you can see in the diagram, in India and Southeast Asia, 48% comes from mobile services, while in Africa, it's 25%. Other sources include home services, which makes 2%, digital TV services, which makes 3%, Airtel Business 14%, and tower infrastructure 7%. And now Meera will move forward with the industry overview.
Over the last 4 years, the top Indian telecommunication company, Jio, Airtel, and Vodafone account for 90% of subscribers. The entry of Jio in 2016 at significant low pricing led to the consolidation in the sector and reduced the industry economics. Airtel is expecting to grow at 17% for next 5 years, and the market's structure will continue consolidating. And by 2025, Airtel revenue share is expected to reach 31%. Jio revenues 47%, and the Vodafone to lose market share with revenue share to decline to 20%. Next slide, please. As we understood, Airtel is gaining market share, and it's for both the home and direct-to-home markets, which have been growing consistently from weak players like BSNL and Dish TV. This low gain is achieving due to poor service and inefficiencies of the public sector undertaking companies. And now Aryan will move this forward.
Yes, so speaking about the industry trends, there's three broad factors that we're seeing, right? So the first factor is in 2015, there was an entrant of a new player called Reliance Jio, and it completely disrupted the entire landscape, which brought down the prices, and which in turn rendered a lot of other companies bankrupt. The penetration is still yet to be achieved. It's not only 40 to 50% of rural areas are connected to 4G and 3G, and the complete penetration has not been achieved yet. So the third factor is an ARPU, which is the revenue collected per user, right? So it's a very integral factor in the telecom industry, is how much revenue can I generate from a customer, and the efficiency of how much I can earn from it. It's the best in Airtel, even though Jio has the highest market share, Airtel has the highest ARPU. Now, coming to the stock price analysis, something I have to mention is the current stock price is 545 rupees, and it's currently dipped almost 20% from the highs it made in December. It has a minimal dividend yield, even though the company is not making profits. When you compare it, obviously, it's below its 200-year moving average, 200 days moving average, and the 15 days. It's above a little above the 15 days average. So, this is the current stock price. Okay. When you move ahead to the competitor analysis, right? So now I previously mentioned that in 2015, there were 8 or 9 players in this telecom industry, right? And when the new entrant came, the Jio, which completely disrupted this industry, took the prices to extremely low, like almost half to them. So in that situation there was a complete consolidation in the market, and which were only like 8 players has come down to only 3. So now ahead I'm showing you is the peer comparison of each of those companies left. So now in these companies, Jio is not included because Jio is a subsidiary of Reliance Industries Limited. Hence, it is not a company that I can find accurate figures about. But in this list itself, there is only 2 companies which have a significant market share, and also MTNL, which is continuously losing market share. The others are practically bankrupt or on the verge of financial bankruptcy, which is Tata Communications, Tata Maharashtra, Tejas Networks, and etc. So now, when we looked at the report, there were a few factors that Airtel's management had to pin on us, and they felt that these are the important ratios that we need to know. So the first ratio was the revenues have completely exploded from 2018 to 2019 and to 2019 to 2020. So the revenues have completely gone up. So the price war, it indicates the price war is ended. When you have a 20% growth in revenue, the OPEX has obviously reduced. So obviously there's more customers, more you're charging them, hence the OPEX has come down. The margins have significantly improved because obviously the competitors have completely vanished. You have the overall debt, which has been reducing. And yeah, I'm sorry. Yeah. So continuing. So now the DCF, right? So while making the DCF, we looked at every industry as a whole, and we try to look at which verticals make money, how much they make money. I can go into the entire details of this. However, it's very time consuming, and I can go after the presentation. I can help you why every number is growing at such a rate and why certain. We haven't looked at free cash flow. We focused on EBITDA because there is a there is a lot of one-time expenditures. Since it's the telecom industry, you've got a lot of one-time expenditures that affect the market. Now, the main important part is the investment thesis, right? So we're bracing the entire thesis is hinged on 4 factors. One factor is the broad-based consolidation in the industry, higher barrier of entry, expansion of the ARPUs of Airtel subscribers, and the third final competitor left is in a turmoil. So now I'll just focus on each point as it is. In the broad-based consolidation in the industry, like I mentioned earlier, 2015, there was an entrance of a high-end player called Reliance Jio, who is also run by the richest man in India, Mukesh Ambani, who came in and drove prices extremely low. That rendered 90% of the market share taken away by only 3 companies, right? So this has earlier taken place in the NBFC and the banking crisis in the last 5 years. Whenever you saw the lower quality NBFCs, which didn't have the highest ability of credit, so the NBFCs with very high diligence and credit ratings and the ability to raise money in turbulent times, they gained market share. It's the same situation we're going to get to see here. And yeah. And the third and the second point is the turmoil which the Vodafone is facing. In December 2020, there was a ruling and that ensured that Vodafone had to pay dues for not only its interest, but interest on interest, which is almost 7 billion. And they are not in a position to pay that back. First of all, I like to quote the words of, the third step is the high barrier of entry. I like to quote the words of Saurabh Mukherjee. If the barrier of entry is not as high as the Himalayas, you will not be able to make with that kind of money. So obviously, the telecom sector is built and hinged on the spectrum auctions, and the spectrum auctions essentially have the ability of how you can monetize your subscriber growth, etc. Right? And your ability to buy into maximum auctions is your ability to translate that into revenues. There were almost 3,14,000 crores which went on sale. However, it wasn't. Expansion of ARPUs has taken place significantly. Now, the risks include there's significant economic turmoil in the market. The markets have gone up by 20%. However, you see the GDP growth has industrial productivity has decreased, and there is overall really problems issues. Spectrum and the final risk is spectrum auction investments is 5%. Only 5% of the auction was bought by Airtel. So in later, if you cannot monetize this revenue, this can be a problem. That's it from me, and I'm.
Good evening, everyone. We're Group 6 and we're presenting on innovative industrial properties. Next slide. This is the content of our presentation, and I will be presenting on the company overview and the financial year review. The commercial real estate industry has grown over the years to include specialized property types that support the growth of specific industry. One that has recently emerged is medical use cannabis facilities. Innovative Industrial Properties Incorporation owns and leases specialized industrial real estate assets. The company focuses on the acquisition, construction, development, and management of industrial facilities leased to tenants in the regulated medical use cannabis industry. The company owned 67, next slide please. The company owns 67 properties across 16 states that contain 5 million square feet of leasable space as of mid-November 2020. It had leased 99.3% of that portfolio with a weighted average lease term of 16 years. These facilities included those used to cultivate and process medical used cannabis, the manufacturing and distribution of products derived from cannabis, and freestanding retail stores that sell medical use cannabis products. These products currently have various uses, including treating cancer, HIV, AIDS, pain, nausea, seizures, muscle spasms, etc. The current stock price of the company is $193.68. The market capitalization is $4,634 billion, and the beta is 1.49. Next slide, please. Innovative Industrial Properties operates in 16 of the 35 states that have legalized cannabis for medical use. These include Illinois, Pennsylvania, and so on and so forth that you can see on the screen. Maximum is Illinois, 17.2% of its portfolio. Next slide. The management team is Catherine Hastings, the CFO and Treasurer, Gary Kretzer, the Vice Chairman, Paul Smithers, CEO, President, and Director, Alan D. Goldman, Executive Chairman. Next slide. Innovative Industrial Properties was founded in 2016 and plans to list on the NYSE. These are the list of events. And now, Patricia will take it forward by talking about the industrial overview and the industry comparison.
Thank you. We will now be presenting the industry overview and competitor comparison of the Cannabis Real Estate Investment Trust in the United States. Identifying the shift of the political and cultural perception of cannabis use over time has highlighted regulated cannabis sales, the sales, and that grew to $20.1 billion in 2020, which is a drastic 52% increase over 2019's $13.2 billion. Next slide, please. There is also a large market and support, with 36 out of 50 American states legalizing cannabis for medical use, including Washington, D.C. It is forecasted that by 2050, all states will have medical cannabis, with half being approved for adult recreational use. Next slide. Scientific researches on cannabis use and its benefits have also gone mainstream, allowing and convincing 95% of Americans to feel comfortable using it if directed by a medical practitioner. For our competitor analysis, these are the top 4 real estate investment trusts that are publicly listed, but we also want to make it known that our stock pitch for Innovative Industrial Properties are the only one being listed in New York Stock Exchange. And as of April 5, 2021, 100% of their properties have been leased until the next 15 to 16 years. Next slide, please. In order to analyze its industry better, it is important to note political, environmental, and cultural effects of cannabis use that is shaping the industry, such as 2020's Marijuana Opportunity Reinvestment and Expungent Act that will decriminalize the medical use of marijuana. Next slide, please. The Bank of America has also predicted that the industry will be reaching around $166 billion in sales annually, with the United States poised to dominate at 34%. In terms of risk, politics will still remain a major influence. Majority of the states that allow cannabis growth and use are Democratic states. Lobbying of pro or anti-cannabis stances can be determined by which political party is in power, and it is not impossible to have federal legalization overturned once parties in power change over time. There is also the risk of compliance regulations that vary across different states. For example, the more variable the regulations are, the more adjustment companies will have to execute, and those compliances can be expensive. Next, Akhilesh will be talking about the financial analysis.
Thank you, Patricia. The revenue, EBITDA, and net income have all been increasing substantially during the past 3 years. While gross profit margin remains at 95%, both operating and net profit margin has increased to more than 55%. The value of total asset increased to $1.76 billion, and it has been funded by more equity than debt. The gearing ratio of the company fell to 0.09. The current ratio of 160 indicates that the company is safe in terms of liquidity. The cash flow from operating activities has increased by more than 50%, while the value of cash flow from investing activities indicates aggressive expansion funded by issue of shares. Both the share price and EPS have been rising at a rapid pace since 2017, but the EPS has been increasing faster than the share price, as a result of which the P/E ratio fell from 150 in March 2018 to 59 in April 2021. We expect a similar trend in the coming years. EPS is expected to reach $9 in late 2022, while stock price should exceed 300 in early 2022, thus putting downward pressure on the P/E ratio. The company's forward P/E ratio is 28.29. The firm weighted average cost of capital is 6.87%, and its predicted profit for the coming years are as follows. The intrinsic value of the company shares estimated by discounted cash flow valuation is $521.53. And now Joshua will elaborate on the company fundamentals.
Thank you, Akhilesh. Now, looking at what makes this stock the stock to invest into, we must first look into the company. In its portfolio, there exist 67 properties over 17 states, all of which fully leased out with an average lease duration of over 16 years. The company has secured themselves into the marijuana industry as a whole and is the perfect stock for getting into the industry while minimizing risk. The company is a real estate investment trust and is hence required to pay out at least 90% of their dividend, and this acts as a big incentive for investors. They have positioned themselves uniquely in the industry to be the biggest cannabis REIT that has access to the capital market. The usual deal size is between 5 million to over 30 million US dollars, followed by leasing back the property for a 10 to 20 years term period. This allows these cannabis companies to funnel their newfound funds into operations, making them more productive and hence more profitable. As long as the industry grows, this company will succeed. The future of cannabis industry in the United States is looking very promising, with 15 states and Washington, D.C. have legalized marijuana for those over 21 years of age, and 36 states legalized medical marijuana. Joe Biden's electoral victory could also mean a big boost to the marijuana industry, as he had previously stated that he would support federal decriminalization of it. Now, moving on to our investing strategy. Next slide, please. We aim to take a growth position and buy the stock for any price under 190 US dollars. Holding the stock for 5 years, we are aiming for a target stock price of at least 500 USD, being a growth of 260% since our purchase. After close to 5 years, we'll reanalyze the industry and decide if the funds are to be redeployed in newer profitable areas. As the industry grows, new players are sure to rise, but IIP will still have a solid position in the market, hence making this a safe and sound investment. Now, moving on to Chaitanya with the risks involved.
No matter how lucrative an investment opportunity appears, there are always some or the other risks involved, and it is essential to be aware of these as an investor. Same goes for innovative. For starters, the price-earnings ratio of the stock is 60 as compared to its peers with a price-earning ratio of 12. This makes the stock a bit expensive in comparison to its peers. The stock price, while still up over 100% so far this year, is down 30% from its high. There's additional fallout from innovative stock price decline since selling shares to fund new investment isn't as desirable as it once was. There are two reasons for this. The first is simply that it takes more shares to raise capital as the stock price falls, and the second is a bit more problematic. Investors may not be as willing to buy new stock as they once were. If you can't find buyers, you can't sell stock. And if you keep trying despite weak demand, you'll put further downward pressure on the stock price, which only make things worse. Now, coming to the risk with growth investing, there are the risks are high valuation. Investors pay high prices for growth stocks, and these high valuations reflect high expectations for the business. And sometimes those expectations become so great that it becomes impossible for a company to deliver. Next risk is execution risk. Business plans always sound great on paper, but they don't always pan out in the real world. If a growth company stumbles in its attempt to launch a new product or service, then the consequences can be severe. The technological disruption is the third risk. Many growth stocks operate in fast-moving industries that are disrupting the status quo. While this can lead to spectacular growth when times are good, the disruptor can sometimes find itself being disrupted by a new technology. Now, coming to our risk mitigation strategy, we suggest pyramiding. Pyramiding involves adding to profitable positions to take advantage of an instrument that is performing well. So, for example, if you plan to invest $1,000 in innovative, then rather than investing $1,000 in lump sum, we would invest $250 every quarter or as per the requirement. This would not only reduce the risk, but also profit us from growing share price. That was our presentation. Thank you so much.